Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London sugar markets. I'll start with ICE raw sugar in New York. Last week, I said at the very start, this market is giving me a headache. Well, things haven't much improved since then. First off, I must again apologise for the multitude of lines and labels I've had to draw on this daily chart. However, technically there's still a lot going on here, and these labels and lines are all valid in my deciphering, trying to decipher what is happening here. The declines earlier this year below the long moving average, currently at 1919, are as a result of three head and shoulders patterns created between August 2021 and January 2022. Now, I have already previously exhaustively highlighted all the three of these patterns and even pointed them out with a cursor, so I will not spend too much time on them other than to say they are complex versions of normal workaday patterns. Only one of them, just one, managed to achieve the primary target on the downside. Nevertheless, there are some interesting points to discuss. The neckline of the October 2021 to January 2022 head and shoulders top, currently at 1714, plus the middle time, after a fashion, currently 1894, managed to stop the decline back at the end of February. The recovery upwards was prompted by an immediate countering weekly key reversal up over the turn of February into March. This recovery rose up to the neckline of the older August to November 2021 complex triple top, currently at 2017, breached it, broke it even, before the rally failed in mid-April, and we've seen prices drop since then until last week. And keep in mind that neckline of the August to November 2021 complex triple top, as it is close to entering the frame of the market once more. Anyway, the mess of congestion support around the middle time, mainly the combination of the February 2021 high at 1894, the medium moving average currently 1888, the long moving average currently 1919, and the short medium moving average currently 1926, eroded the bearishness over the last 3 weeks, such that though prices pushed below all of them, the market did not have the impetus to push further down. That is below the congestion from February between 1840 to 18 even, which within sits the 50% absolute Fibonacci line for the 21st century. Thus, 2 Fridays ago, the first bullish shots were fired with a daily key reversal up, which was halted in its rise by the same congestion of moving averages, the long and short medium moving averages. This rise actually did a lot to fill in the change gap earlier in the month, but it was still open as a gap. Then last Thursday, the market made an immediate countering bullish engulfing pattern that led to last Friday's bullish long white Mariposa that very nearly made last week an outside week. It was only the same old long and short medium moving averages that kept the lid on the rise. However, today, prices have gapped higher and risen up clear of all the moving averages. Interestingly, this gapping action, if sustained, would mean that the past 2 weeks could be seen as an island bottom of sorts. Additionally, the long and the short medium moving averages are now support, not resistance. Plus, the market is in a fairly clear area all the way up to the neckline of the complex August and November 2021 triple top that I asked you to keep in mind. And that was earlier in my discussion. It will now be very interesting to see just what happens up here over the next few days, as they might give a clue as to what may be next, unlike the more recent days, which, as I have started with, have given me a headache. ICE Europe white sugar in London. Before I go into the very, very interesting thing that happened last week, I'd first like to cover some of the groundwork. You see, this market made a big meal from the break upwards out of the September 2021 to February 2022 lopsided diamond pattern. The move up took its own time, but in mid-April, the market reached up to target X in the 572.20 area. This was the target for the mid-February to mid-April bullish half hesitation. Since then, we've had the changeover gap lower, and prices have pulled back to the vicinity of the congestion from early 2017 in the 517.80 area. This area is actually a complex zone, as it also includes a neckline from the August to December 2021 complex head and shoulders pattern, At the Head and Shoulders top, that's currently at 5 at 19.90, as well as the important rising medium moving average, currently at 5.17 even, and the rising long moving average, currently at 5.08.20, it's just below and moving into the market frame. This is why for 3 weeks we have seen prices hold over and around the 5.17.80 area, more or less, and under the old gap from March 2017 between 5.31.70 and 5.32.70. The question I posed last week was this: what does this period of intraday indecision, what does it signify? Does it signify a bottom, with prices moving back up to the May 2017 high resistance at 548.70? Or does it signify a halfway hesitation, with prices tripping down below all the moving averages, as well as the congestion area 488.10 to 490.10? That was the question. And to be honest, at this time last week, there was no indication as to which course of action was preferred. Hence, and I quote, "I would try to keep an eye open on any moves below the long moving average or over the old gap from March 2017, end of quote. Well, last Thursday, the market tried exploring the downside, but was rebuffed at the support at 509.5 and ended up making a combined daily key reversal up and bullish double. This was followed by last Friday, with a gapping higher move since then filled in that punched up and closed not only over the previously mentioned old gap between 531.70 and 532.70 from March 2017, but also closed over the rising short medium moving average, currently at 534.30. The result of this move was also a reverberating one, as it made last week a weekly key reversal up. Today we have gapped even higher, but have not as yet tested the next overhead resistance of note, and that's the March 2017 high at 548.70, which is a little worrisome if this move is to continue higher. You see, after this 548.70 level, we have nothing of major note until the February 2017 high at 565, and then the filling in of the changeover gap. That's between 554 even and 572.5. This is one to watch. Sugar white premium spread. I said last week that this spread market speaks volumes as to the state of the current New York and London markets, both individually and collectively. I was of course referring to the 3 weeks prior to last week, where we had one indecisive spinning top and 2 consecutive indecisive doji crosses in a row. All this came as the market was trying to make sense of a false break higher over March and April, and what's still since late April. You see, we've had an ascending wedge pattern formed between July 2021 to date. It is a reasonably good looking pattern, and I would not normally expect problems from such an action. However, problems are what it has given, as the lower trend line is the mid-August 2021 to April broken uptrend, currently at 123.25, and the upper trend line, currently 121.5, bisected the uptrend last week as we ran out of space in this ascending wedge pattern. There are 2 further patterns, one of which I'd previously drawn your attention to, which still need to be discussed. The first is, it is a quiet and subtle bullish bow tie formation formed over Christmas last year, made up from the short moving average, currently 111.25, the short medium moving average, 113.25, and the long moving average, currently 181.5. What had been interesting back at the time of its formation was how all the moving averages went in and out of the bow tie in the right order, a rare feat in some markets. Theoretically, the market should move in the direction of the outgoing moving averages, in this case higher, which we have already seen happen. However, the key move should happen between 15 to 20 trading sessions after the crossover. In this case, it will be between the weeks of the 4th of April and the 9th of May this year, or in other words, last week was the end date of it happening. Now, I had asked many weeks ago to put a note in your respective diaries and calendars for that period, just in case. Well, we had a big move up during the week of the 19th of April, but it was not sustained. However, last week produced a very interesting pattern on its own. You see, last week was a weekly key reversal up. Thus, this market could very well be wrenching victory from the jaws of defeat by just the one action right at the end. Now we shall see. Finally, there is one more pattern I'd like to discuss briefly, and it's once again as well. I'd previously spoken about it this way, and I quote, "There is a pattern which, whilst not directly touched, may be indicative of the bullish angle of attack. It is the 2019 to 2021 bullish Andrews pitchfork. The market is currently in between the middle time overhead, currently 134 3/4, and the lower time below, currently 60 3/4. End of quote. I further added, and I quote, "The upper trend line of the ascending triangle runs approximately parallel to the middle time, and that is also something to watch." End of quote. This bullish Andrews pitchfork is still operational and provides, with its middle time, the next major obstacle should the market wish to extend last week's weekly key reversal up even higher. Maybe, just maybe, we're seeing the beginnings of a new, or shall we say further move, here, higher. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Investor Services International Limited. And here comes the final bit.